What's happening, y'all? Listen, in this video, in this live stream, I'm gonna go over day trading and I'm gonna go through the basics. I'm gonna walk you through step by step, hold your hand, guide you through the process. This is not 100% a master class. I'm not teaching you everything I know in this video, but this will be able to get your feet wet, get you started, get you rolling. I apologize for the lack of content creation. I ran out of memory in my phone, so you're gonna see a lot more live streams. I'm still doing a swing trade Sunday tomorrow. I got a good play for y'all tomorrow. But let's get into the basics of day trading. So day trading is a perfect way to maximize profits, right, in the stock market. And what you're doing, you're making short-term predictions on the stock price. So the main thing with day trading is going to be your candlestick, right? So let me pull up the candlestick. And the candlestick, it determines price. You find the candlestick on tradingview.com. But first, let me go into understanding the candlestick basic, right? Let me make sure y'all can see this. All right. So in the candlestick, when you're day trading, when you're looking at charts, these candlesticks represent a certain time frame. You have time frames from a 2 minute time frame all the way to a monthly time frame, right? So if you're day trading, you want to stay within a shorter time frame, anywhere from 2 minute, 5 minute to 15. My favorite time frame to day trade on is the 2 minute. And then if you're swing trading, the best time frame is the daily time frame. But whatever time frame you're looking on, if you're day trading and you're on the 2 minute or the 5 minute, the candle represents price movement during that time frame. So if you're trading on the 2 minute, one candle represents 2 minutes. All right, so you have two types of candles. You have green candles and you have red candles. And what that represents is that during that time frame, the buyers outbeat the sellers, right? And then on the red candle, you have the sellers outbid the buyers during that time frame, because in a market you got buyers and sellers. It's a stock market, so it's a relationship between buyers and sellers. So on this example from investopedia.com, the black one is a red candle, the white one is a green candle. So on the red candle, you can see that no, I'm sorry. This is actually yeah. So the black one is the red and the white one is the green. So a red candle means that during that time frame, the stock price went down. But this is how you determine this red candle, right? So on the red candle, if you notice where it says open price, that is where the stock price opened during that time frame. So you have four components of each candle. You have the open price, the close price, the high, and the low. So what this looks like on this green candle is that the price opened here. Most likely it probably went up initially and then came back down. The top of the candle is the opening price on the green candle, and the bottom of the candle is the closing price. The wicks that are created is movement during that time period in between the open and the close. So if this is a 2 minute, it opened right here, and it probably most likely in this case it went up. Sorry, this is a red candle because it closed lower, and I probably said that, but the red candle, it closes lower than the open, and the green candle closes higher than it opens. So what it looks like, what happened here is right where you see open price, the candle started there, it went up to price high, then it probably came all the way back down to price low before going back up, closing to the closing price. So that's all the characteristics that happen during that time frame that you're looking at the candlestick, right? So let me bring up the chart so you could get that into perspective. And the same vice versa with the green candle. Vice versa with the green candle over to the right. You can see where the price opened here. The low of that time frame was here, which means most likely it went down initially, went all the way up to the high point, and then probably came back down to where the close point is. So remember, on green candles, the bottom of the candle is the open, the top is the close. On a red candle, the top is the open, the bottom is the close. And the wicks are whatever happened in between. If the stock went up higher than the open and came back down, it'll create a wick. If it goes lower than the close, so on and so forth. So that is the candlestick. That's the main thing you need to know. So let's actually to look at candlesticks on a chart, right? And when you're looking at a chart, you want to do your charts on TradingView. This is where everybody look at their charts at. So if you're looking on TradingView, you got, this is on a 2-minute time frame. So each one of these candlesticks are 2 minutes. And you see, just like I explained, they all have wicks. And what's that basically telling you? Let's look at a candle with a long wick, right? So what's that basically telling you is that when you see a long wick like over here, you see a long wick. Let me put a little smiley face near the long wicks. When you see long wicks like right there, see long wicks like right here. Hold on, let me put another one. So long wicks usually tell a story. I'm gonna give y'all 3 quick examples what I see right here, right? So long wicks on a candle. Let me make sure y'all can see this. Long wicks on the candle shows like a level of rejection, right? The stock had went down a whole lot and it popped back up, or it went up a whole lot and popped back down. So if you notice in both of these 3 different examples, with these candles having long wicks, it showed a change in direction, right? You see this got a long wick, the stock changed the direction. This had a long wick, it changed the direction. This had a long wick and it changed the direction. Now, if a stock has a long wick, that is not a guarantee that it's going to change in direction. But usually stocks with long wicks, if it's a long wick to the bottom, that means buying pressure is pushing it back up. And if it's a long wick to the top, that means that it's going, chances are it's probably going up. Of course, in order to day trade, you want to identify individual candlesticks, right? So let me go over just like one of them with you, which is one of my favorite, which is a reversal candle, right? So you got the hammer candle, right? The hammer candlestick is a reversal candlestick, is a bullish reversal candlestick that appears at the end of a downtrend, and it's a small body at the top and a long wick below. So if you look at these examples, the hammer candle is coming, it's at a point of it's coming on a downtrend, and then it's a reversal. Now the hammer candlestick, my bad, y'all. The hammer candlestick by itself is not something that you should just trade off of by itself, right? There's other things you want to add into that, and I'm gonna get into that in a second. But different candlesticks mean different things, right? So you have single candlesticks that can give you an idea of what's going to happen next, but you also have candlestick patterns. So let me get into candlestick patterns. So you have single candlesticks. You also have double candlesticks. Let me pull up a bullish engulfing real quick so y'all can see that. All right. All right, let me pull up the bullish engulfing. All right, so a bullish engulf is another single candle pattern, right? And the bullish engulfing is either you have bullish engulfing and bearish engulfing. Bullish engulfing is when a green candlestick, the entire body engulfs a smaller red candlestick. What that is also a sign of reversal. If you're looking at the examples in the bottom, it's usually at a downtrend and then buyers just outbid sellers like crazy, right? So it's a sign of reversal. It's a two candlestick pattern versus like the hammer is just one candlestick. The bullish engulfing is a two candlestick patterns. So you can trade off of individual candlestick patterns. And let me go over one more pattern. You want to learn all of the candlesticks and all of the candlestick patterns. That's first and foremost with trading. So let me show you the bullish engulf. Let me show you one more pattern real quick. And that's the hold on. I'm gonna pull up the bull flag for y'all real quick. All right, so the bull flag. All right, so the bull flag pattern. So you have individual candles that can let you know what's going on. You have two sets of candles, but you also have patterns. So if you look at a bull flag, the bull flag is looks like it's going in an uptrend, then it consolidates for a little while, and then it continues to go up. It's not considered a bull flag unless it breaks out of that higher end of the candlestick, right? So you want to make sure, just like in these examples right here, is breaking the high of that choppiness after going up. So you got your candlesticks, you got your candlestick patterns, right? Let's go to the chart. Let's see if we can identify some of these patterns, right? Let's go to the chart. Let me see if we can identify some of these patterns. So I'm gonna skim through this chart a little bit, see if I could identify a pattern on the chart and show y'all what's up with that. All right, let me make this larger so I can actually see. All right, so this is on a daily time frame, which means each candle represents a day. But if you notice, I'm seeing a bull flag, like I mentioned earlier, and I actually see a double bottom. So let me pull y'all back up so I can see. So over here, let me put a little smiley face. Over here, we got a double bottom, right? Over here, we got a double bottom, and over here, we got a bull flag. Now, as you can see, and don't get me wrong, the patterns don't always look perfect, but if you can see, it's been going up and it consolidated. So you could have expected it to go up from there. Now, that's not always a guarantee. That's why you use risk management. Don't use all of your profit all at once and trade with a stop loss. But we got a bull flag and we got a double bottom, right? So candlestick and candlestick patterns is the first and foremost thing that you need to learn when it comes to day trading. Right, now let me pull up the double bottom just so y'all can see that real quick before I move on to the next thing. All right, so the double bottom pattern. So as you can see, the double bottom, it basically creates a W. Now you could look at this on any time frame. If you're looking at this on a longer time frame, like the daily, weekly, or monthly time frame, something like that, those time frames are going to be over a longer period of time. So the longer time frames will give you the direction that the stock is going over the long term, or an idea. So if you see a double bottom on a daily chart, you should expect to day trade or swing trade for the next couple days going up. If you see it on a 2 minute time frame, then you can, probably just for the next two candles, just for the next 2 minutes, what I'm saying, be in the trade for that. But first, you want to learn candlestick, then you want to learn candlestick patterns. The next thing you want to do is you gotta understand the market sentiment, right? And what I mean by the market sentiment is, the trend is your friend. So you gotta know which way the trend of the market is going, and there's a couple ways to do that. So this is before you even picking a stock, before you even identifying which way you want to go. You want to get a feel for which way the market is going, which way you expect the market to go, right? So I got like three ways of doing that. I'll just show y'all two for this purpose, for this video. So the fear and greed index, if you notice on Swing Trade Sunday, I always go over the fear and greed index. Of course, with day trading or swing trading, it's a market between buyers and sellers. Buyers and sellers have emotions. So when there's greed in the market, you want to take heed, because people get over greedy and it could revert back. So currently the market is greedy. The trend is your friend. So for the next couple of days, you should probably, next day or two, this tells me that you could probably expect the market to still go up, but it's greedy. So you could expect it to continue to go in the other way, because we haven't reached extreme greed yet. And even though it's at a 74, that doesn't mean it has to go to 84 before it goes back to extreme fear. But it's something you want to keep in mind. You want to get a temperature and understand how people are feeling about the market. And people are feeling extremely greedy. One of the best investors of all time, I believe, is Warren Buffett saying, but they say, be greedy when others are fearful and fearful when others are greedy. But you also want to go with the trend. So when we're extreme greed or this high in greed, like at a 74, keep your eyes open, because we could be at some point soon making a reversal. But that's just like the sentiment or whatever. Another thing I do, I look at the total stock market index. So the total stock market index is an ETF that goes over it's basically every stock in the stock market is included in this ETF, which an ETF is an exchange traded fund, right? So VTI, this is every stock in the stock market. So I look at the fear and greed index and I look at VTI and I see what I think VTI is going to do, right? So I went over the candlestick. Now I'm going to go over indicators. And this isn't all of the indicators, but these are all of the indicators that I use, right? So it looks like, of course, VTI, the total stock market, it looks like we're going up and we're in an uptrend. But how you gauge, do you feel like it's still going to keep going up? Do you feel like it's going to reverse? All of that is predetermined. You got to use indicators and other things to show you, right? So it's making higher highs. It's up there. It's going up. But now we're going to use indicators to identify how high is it? Does it have more room to go? And all of that. So right now we're looking at the daily time frame. The daily time frame gives you the best outlook on what you can expect the stock to do for the next day or next 2 days. And when you're day trading, you want to trade based on seconds and minutes. So you want to go to a smaller time frame. But when you want to look at what you expect it to do coming up, you look at longer time frames. So we're looking at the total stock market, and I'm gonna add my indicators and explain all of them. So my favorite indicator, or one of my favorite, is the Bollinger Band, right? Let me make sure y'all can see the Bollinger Band. All right, so the Bollinger Band. The Bollinger Band has three components. That top red line is the top of the Bollinger Band. The bottom green line is the bottom of the Bollinger Band. And the middle line is the 20-day moving average. So moving averages, and I'm going to go over that soon because I got other moving averages that I use, but moving averages not only play a level of support and resistance, but it also shows you the trend, right? This moving average is slope upwards. So that means that it's trending upwards. If you look back down here, the moving average was sloped downwards. That means that the stock or the total stock market was sloping downwards. Now, moving averages are lagging indicators, which means it's going to give you information probably a little later than, the initial move. But at least you can identify the trend a little later. You also have leading indicators that can help you combine with the moving average. But the Bollinger Band, and I'm gonna pull up a little explanation on here too. The Bollinger Band, the stock basically trades within the Bollinger Band. No, I don't want image. I want the definition. All right, so let me pull this definition of the Bollinger Band up, y'all, so y'all can see. All right, so the Bollinger Band, and this is a great indicator. I'm telling you, I love it. The Bollinger Bands are let me make sure y'all can see this, are types of price envelope, a price envelope developed by John Bollinger. Opens in a new window, price develop upper and lower price range levels. Bollinger Bands are envelopes plotted at a standard deviation level above and below a simple moving average, right? So that middle line is the 20-day moving average, and the top of and bottom of the Bollinger Band are basically support and resistance levels. Resistance is something that's going to knock a stock back down. Support is something that will knock a stock back up. So as you can see the example right here, and we're going to go back to the chart and go over the Bollinger Band. So outside of learning the candlestick, outside of learning the candlestick pattern, you also got to get a feel for the market in its entirety, and then you got to add your indicators, right? So we on VTI on a daily time frame, and we're at the top of the Bollinger Band. You read candlestick charts from left to right. So hold on, y'all. Hey, baby.
Hey, what are you doing?
I'm doing a live on YouTube right now.
Sorry. I was trying to see if you could read this. Okay.
All right. What, like an hour?
Yeah, that's fine. I want it called
Okay, just text me what you want.
Okay, love you.
Love you too. Bye. All right, so the Bollinger Band shows support and resistance is not a guarantee every time, and I want to show y'all this. So as you can see, the total stock market, we popped all the way down, way outside of the Bollinger Band. So the Bollinger Band isn't guaranteed, it isn't definite, but in most cases, there's nothing definite in trading, but in most cases, if you look, we are always inside of the Bollinger Band. right? So a moving average, if a moving average is sloping upwards, or well, it's not going to slope upwards till later because it's a lagging indicator. But as you can see, as I'm going back, the total stock market, and this will work for any stock or whatever, but we currently are looking at VTI, which is the Vanguard Total Stock Market Index, which is every stock in the stock market. Which is important to know which direction the stock market is going because you want to trade with the trend. So if you like to trade Apple or Amazon, or you want to trade an individual stock, you want to know what the total stock market is doing and the index that that stock is in, right? So with the Bollinger Band, as you can see, when it gets to the top, it comes back down. When it goes to the bottom, it goes back up. So I'm looking at the total stock market and I'm making my plans for Monday. I'm keeping my eyes open for going down, right? I'm expecting the stock market is most likely going to go down on Monday based on the Bollinger Band. So let me add some more indicators and we're going to go and we're going to do it like that. So that's the Bollinger Band. That's one of my most favorite indicators. Now we're going to go over volume. Volume, you can't trade without volume. So volume is these green and red lines down here at the bottom. When you see a big spike in volume, that means that there is a lot of support. That means there is a lot of support behind that movement, right? So volume is actually showing what sellers are doing and what buyers are doing. So when you see this red volume spike, that means that there was a lot of participation, a lot of sellers in the total stock market on that day, pushing that stock down. So you have to have volume indicator, which once again is these red and green lines down at the bottom, showing actual participation from the buyers and sellers. So this is on a daily time frame. If you're looking on a 2-minute time frame or 5 or 15-minute time frame, those are your day trading time frames. And when you see a volume spike, let's go to the 2-minute time frame and let's see if we could see a volume spike on a 2-minute. All right, so we do have some volume spikes on the total stock market index. Now, if you look directly, hold on. Let me make sure y'all can see this. So if you look directly where these big spikes are, directly above this big green spike is a big green candle. So volume bars show actual participation between the buyers and sellers. So that's another indicator you have to have on your chart. Volume is actually proof and evidence. Some of these indicators are lagging and the move might happen before the stock moves. But volume bars are actually evidence between buyers and sellers, or aggressive buying or aggressive selling during that time frame. Once again, you want to day trade on 2-minute, 5-minute, and 15-minute time frame, and you swing trading off of like a 4-hour, but most important, the daily time frame. The daily time frame is going to let you know which direction that you should be day trading in. So since on a daily time frame we looking like we are at the top of the Bollinger Band, if I was to trade VTI on Monday, I'm not trading unless it could go up in the morning, it could be going up all morning, but I'm not trading unless it's going down. You know what I'm saying? So it's setting up a game plan. We're at the top of the Bollinger Band. Can we go higher? Yes. But the Bollinger Band is letting me know that we can expect a reversal soon. If not Monday, maybe Tuesday. You know what I'm saying? Could be as late as Wednesday. I doubt it. So let me add some other indicators on this chart. So as you can see, you want to learn your candlestick. You also want to learn your candlestick patterns. But the next thing you want to do is learn indicators. All right. So the RSI. The RSI is my second favorite indicator. I feel like the Bollinger Band and RSI are at least the most two mandatory, and the volume bars are at least the most two mandatories um, on your trading. So the RSI is this yellow and purple line down here at the bottom, right? And what it does, it lets you know overbought or oversold. So if it's overbought, that means the price is too high. If it's oversold, that means the price is too low and you can expect a reversal, right? But it also lets you know if a direction is going to change, right? So if it's overbought, it could be coming down. If it's oversold, it could be going up. But also when those lines cross, you also get a change in stock price, right? So let's look at this. So if we look, we got a cross, and the RSI is a little bit lagging too, because right here is where the stock started to go up, but the RSI crossed over here probably 3-4 days later. So the RSI is a strong indicator, but it is also a lagging indicator. So the next indicator I'm gonna go over with y'all is not so lagging. But so if we look at the RSI is not overbought. But another thing I like to do on my RSI is I like to combine indicators. You know what I'm saying? I like to combine indicators just so they working together. Like you know what I'm saying? So I'm gonna add the Bollinger Band to the RSI. Where's the Bollinger Band? So if you add the Bollinger Band to the RSI on a daily time frame, on the total stock market index, as you can see on the RSI, we still got a little bit more room to go up. It's not completely overbought. And what I like about the Bollinger Band is that it shows hidden resistance or support on the RSI, right? Because if you just going based off of, I think the RSI is between like 70 and 30 or 70 and 20 is overbought and oversold. If you just going off of that, the bottom of the Bollinger Band is here at 55. So you know that, okay, 55 is oversold. It's not going to go all the way down to 30 or whatever. So the Bollinger Band on top of the RSI, love that indicator. And make sure you do your own due diligence. Look these indicators up for yourself. But now I'm gonna go over the next one, which is the stochastic. The stochastic oscillator is literally dang. So the stochastic oscillator is this one down here at the bottom. And it's literally the same thing as the RSI, but it moves faster than the RSI. So on day trading, the RSI, the stochastic oscillator is going to let you know the stochastic, and that's this one on the bottom, the blue and orange line. The stochastic oscillator is going to give you a signal before the RSI. So it moves faster. So I use the stochastic oscillator as like, okay, well, the stochastic oscillator is our blue line is crossing the orange line going up. Let me see if it's about to do that on the RSI. You know what I'm saying? I'll let the stochastic give me a jump start on what I expect the stock to do. So if the stochastic did it already and then the RSI is about to do it, then that gives me a heads up. So on the Bollinger Band, when they cross either up, going up on the middle line of the Bollinger Band, which is the 20 moving average, if it goes above it, that's a bullish signal. You want to think going up. And if it goes below it, you want to think going down, right? So let me drop a couple more of my favorites. So I like the 9 moving average, the 20, the 50, and the 200, right? So I'm gonna explain them. So the 20 moving average, the 20 moving average most likely is this one hanging close to the stock movement. This yellow line right here. And the reason that moving average, the 20 moving average, is my favorite for day trading because it gives you perfect entry and exits, right? Because moving averages also play as support and resistance. So if you're at the, say you at the bottom of the Bollinger Band, right? This the bottom of the Bollinger Band, this green line going up. And then you got this moving average right here. And then the stochastic and the RSI are oversold. And it's hitting this moving average down here with a hammer candle, which, if you remember from earlier, the hammer candle is a reversal candle. That is a perfect trade setup. So you want to identify so many things at one time, right? The RSI being oversold, the stochastic being oversold, and then we're coming down to the bottom of the Bollinger Band or below the Bollinger Band, and we're bouncing off of this moving average just below the Bollinger Band with a hammer candle. So you got the hammer candle showing a reversal, bouncing off of support, oversold on the RSI, oversold on the stochastic. Those are perfect trade entries. So let me drop a couple other indicators on there I use. Oh, let me go over the moving averages. My bad. So the 20 hangs close to the stock price. You can use the 20 as entry and exit. You know what I'm saying? You can use it as if it's riding up and it goes below the 20. And since we talking about day trading, I'm gonna go on a day trading time frame. So, and the strongest moving average is the 200-day moving average. And when the 200-day moving average is sloped up, it's a bullish sign. So let me go back to the chart so y'all can see the slope of the 200. So the 200-day moving average is this purple line down here, which is the strongest out of all of them when it comes to support and resistance. And when it's sloped up, that means the stock market is trending up. So you also want to pay attention to the slope of the moving averages. Now, as you can see from here, it's temporary sloped down, and the stock market went down. Now it's sloped back up, and the stock market is going up. So not only do the moving averages play as support and resistance, but they also slope down and slope up, with the 50 and 200 moving average being the strongest level of support and resistance. So, like I said, if you have a hammer candle touching the 200-day moving average, then you know that's a great sign that the next day, or if you day trading and you on a 2-minute time frame, you know that that's a good entry for your trade. So you want to, before even getting into your 2-minute or 5-minute or 15-minute time frame, if you are day trading, you want to look at the total stock market, and we are up there. According to the stochastic, we are at the top. We had like 95. So we're overbought on the stochastic. We're at the top of the Bollinger Band. We still got room on the RSI, but that doesn't mean that it's always going to go up. So I'm getting the feeling, based off of my indicators, I'm getting the feeling that the market is going down on Monday. So on Monday, I wouldn't be doing any trade unless it's a put option. Put options is where you expect the stock to go down, Call options are when you expect the stock to go up. So let me go over another indicator that I use, and I use the pivot points. We almost done with my indicators, y'all. I know I got a lot. So pivot points. So let's go to the 2-minute time frame, which is a day trading time frame. It's my favorite. So pivot points. Pivot point is a perfect place to take profit or scale out of your position, right? And what I mean by scale out of your position, if you in a trade and you up $500 and you feel like it's going to go up more, you could take half off the table, take those profits, see if it's going to go up more. And then, you know what I'm saying? If it ain't, then you know what I'm saying? You could just do you like that. But so the pivot point. So based on the 2-minute time frame on the total stock market index, we see that the stock market on a daily time frame is overbought, right? But on a 2-minute time frame, it's oversold. Let me pull this back up so we could go back over it. So we got the stochastic down here at the bottom. We got the RSI at the bottom of the Bollinger Band, and we got a hammer candle at the bottom of the Bollinger Band on a 2-minute time frame. So if we look at the daily time frame, we're overbought, but on a 2-minute time frame, we're oversold. So what I would expect to happen, you know what I'm saying? And you can't really predict the market. It's not really a good idea to front run the market or assume or anything like that. But what I would expect to happen is the stock market to start to go up Monday morning, and then it's probably gonna come down, right? It's probably gonna come down and be down on the day, making a red candle. Let's see. That might be all of my indicators. We got moving average, Bollinger Band, pivot point, RSI, stochastic. Yeah. So this is my last indicator, which is the normal smooth MACD. So the MACD basically shows you, a turn in price, right? And it's like the easiest indicator. So it shows you a turn in price. If you look at this normal smooth MACD, when it turned green, the stock market went up until it turned red. The MACD is also a lagging indicator. The RSI is lagging, and the moving averages are lagging. So the stochastic is a pretty fast indicator. It could be at the bottom real quick and then pop up. So you want to mix lagging indicators with leading indicators. And I'm not sure if the stochastic is a leading indicator, but I look at it as one, and it works for me. So we're oversold, right? So this is how you kind of look at your play. You kind of look at your setup, right? We're oversold on the Bollinger Band with a hammer candle. A hammer candle is a reversal candle. We're also oversold on the RSI according to the Bollinger Band. We're down at the bottom on the stochastic, and the MACD is about to turn green. So that goes with the play. On a short time frame, it looks like the stock market is going to go up. On a longer time frame, it looks like the stock market is going to go down. So how I would play this, if I was actually trading the total stock market, I would expect it to go up. Now you could trade in both directions. So you could trade it going up and then trade it coming back down. But I suspect, based off of what the chart is showing me, that the stock is going to go down for the most part. So those are my indicators. That's the candlestick. That's indicators. And that's looking at the total market. So now if you look at the total market and then you want to look at a particular stock, Um, I don't know, Wells Fargo, or I don't know, say Ford. So you always want to look at the entire stock market before you even look at an individual company, because you want to see which direction the stock market is moving. So we know that the stock market is oversold. We know that there's greed in the market. So we should be expecting a pullback. Now you never want to front run the stock market, but you want to have a game plan. So my game plan for Monday would be to trade the stock market going down. If that doesn't happen on Monday, I might could make a quick bull play, or a quick call option, or a quick put option. But or I could just sit out for that day and wait till Tuesday. If it don't happen Monday, okay, I know it's gonna happen Tuesday, because we all the way up there. So that is candlesticks, patterns, and indicators. The best time to day trade is going to be your first 2 hours of the day and the last hours of the day. That's when there's the most fluctuation and liquidity in the market. And fluctuation or momentum is how you're going to make a lot of your profits, because when you're day trading, you just want quick movements in and out. You know what I'm saying? So when you're day trading, you just want to see them quick little, you just want to make quick little pivots. So as far as how much you're making day trading, I'll give y'all an example. I did record a live day trading video, um because I don't really know how to explain to y'all, like, I don't really know how to explain to y'all, like, how it's priced in or anything like that. So I'm gonna just show y'all the video a little bit so y'all can see the price movement, but on top of the price movement, like how much I'm making off of what I invested, or whatever the case is. So I don't want to drag this out too long either. Let me speed it up. All right, so the stock market. So this is literally 9:30, and the stock market just opened. Let me see if I could make this bigger. So this is 9:30. The stock market just opened. All the way over here to the right, you can see that is, and this is on tradingview.com, is where you see a chart. All the way to the right, that is where you see the current stock price, but also how much time is left on that candle. This is on a 5 minute time frame. At the time, I used to like to trade on a 5 minute. Now I trade on the 2. But as you can see, the stock price is at what, 175.50 or 175.70, and it's 2 minutes and 56 seconds left on that candle. So the candle is doing this motion. You'll notice that there's a lot of fluctuation and gyrating, you know what I'm saying, when a candle first open. But you want to make quick movements on a day trade. You don't want to be in a day trade too long. You want to get in and get out, take your profits, and dip. High probability setups only, and proper risk management. Risk management by journaling. Write down in your journal your trades, and you'll learn your behaviors. Um, Constant education. Watch me on YouTube. Watch other people on YouTube. Read books. Take courses. This thing ain't taking too long, man. Let me speed it up. So this trade wasn't really based off of no indicator or nothing like that. I just had a suspicion, which you shouldn't really trade like that, to be real. But I had a suspicion, and I just went with it. Also, so Even though the first 2 hours, first 2.5 hours are the best time to trade, you want to avoid the first 15 to 20 minutes. The first 15, 20 minutes um, is a lot of fluctuation. On top of that, you also have, if somebody's swing trading from the night before or from a month ago or a week ago, they could be, the big institution could be getting out of a big trade. Large institutions could be getting out of a big trade and they get out and flush it down. The stock market flush first thing in the morning because they were in a trade from the day before or a week before and they got $20 million invested in that stock and pull it out the next morning trying to catch some of that overnight movement. So this is off of $4,500. This is showing you the candle. This is showing you the candle and the difference in price with it going up. So as you can see, just with that little bit of movement, I'm already up 150. You know what I mean? That's a day's salary for some people. You know what I'm saying? And that's off of like couple seconds. Off of, you know what I mean? What's that, 40, 45? You know what I'm saying? Let that 45 print for you. And it just so happened like this, the stock market isn't always just going to have one candle to just keep coming down like that. It's going to make different movements and, you know what I'm saying? It's going to be different things happening during the process. But also keep in mind, the trend is your friend. Once we finish this, I'm going to go over trend lines with y'all a little bit, which is another form of support and resistance. So we already up like 400, and this is in seconds, right? So that's with 9 contracts. Of course, if you have 2 contracts, it's going to be less. If you have 5 contracts, it's going to be less. But this is literally $500, $540 in minutes. So that's kind of that's the best example that I could explain on how the price works or whatever. So I'm gonna go ahead and get off of that. I think y'all got the idea. I think I made like $700 on that day. But let's go back to the chart. VTI. Also, the stocks that you trade are very important. Technology companies lead the stock market. So when you're looking at VTI, they are the highest percentage of VTI. I'm talking about Amazon. I'm talking about Nvidia. I'm talking about AMD. I'm talking about Apple. They're the biggest percent of, and it's a small percent, probably 20, 30%, but they're the largest percent of VTI. So when VTI is up, technology is up. But that also means that another sector is down because of market rotation. So you have stocks that certain sector of stocks perform differently from others. So if technology is up like it is currently, then you can find another industry that's down, right? So technology is up and you want to do a swing trade, which I'll go over swing trade tomorrow. I got a swing trade set up for y'all. I know I missed last week, but this swing trade setup tomorrow is gonna make up for it. Currently, I only have one, but I'm gonna go over that with y'all tomorrow. So trend lines, and you can do this on any time frame, but trend lines, you go over to this little. Let me make sure y'all can see this. My laptop about to die, so this is the last thing I'm gonna show y'all. But trend lines is you could literally go from one point, and this is another form of support and resistance, right? So we on a 2-minute time frame. So you notice that's a significant spot for VTI. So say this is the stock that I wanted to trade, which it's not a stock, it's all of the stocks. It's an index fund. That is another level of support and resistance. It hit that level 3 times. So you have vertical and horizontal support and resistance, right? So if you wanted to use that trend line as a support and resistance, you could be like, okay, well, I'm gonna enter the trade, and once it breaks that trend line, then I'm out. You know what I'm saying? If it's going up and down and doing all of that, and then once the trend line is like up here and it finally breaks it, you can use that as an exit. But you use support and resistance, moving averages, Bollinger Bands, use those all as entries and exits. If it goes up through the Bollinger Band or it goes up through the moving average, then you know that it's a good catalyst that it could continue going forward. Or it could be creating a wick, doing a fake out. In that event, you get out. That's it for the day. That's not everything I know. That's not everything you need to know, but it's a good starter kit for day trading. Make sure you read your candlestick Bible. Make sure you listen to Day Trading for Dummies or Technical Analysis for Dummies. Keep watching my channel, man, and like and subscribe. Tap in tomorrow for my free swing trade play. Swing trade Sunday tomorrow, y'all.